Most people do not really want passive income. What they really want is relief. Relief from alarm clocks they hate, relief from managers who waste their time, relief from the feeling that every bill in life must be answered by another hour of labor. I understand that desire very well. What I do not respect is the fantasy built around it. The internet sells passive income the way the travel industry sells postcards. It gives you the beach without the flight delay, the margarita without the bad sunburn, the ocean without the storm. It gives you the cash flow without the structure that produced it. It gives you a life without a paycheck, but somehow also without sacrifice, without uncertainty, without maintenance, without boredom, without tax, without sequence risk, without inflation, and without the strange psychological shock that arrives when work disappears, but purpose has not yet been rebuilt. That fantasy is expensive. It causes ordinary people to aim for the wrong thing in the wrong way. So let me tell you what I actually believe. Living off assets is possible. Living well off assets is possible. Living permanently without being forced to trade hours for dollars is possible. But the clean version the public usually hears is mostly fiction. True hands off passive income is rare, fragile, expensive to acquire, slower to build than advertised, and much less passive than people imagine. Once the calendar starts filling up with the real work required to keep the machine healthy, that does not mean the whole idea is false. It means the wrong picture is false. I want to give you a better one. I want to start with the simplest sentence in the whole subject. Living off passive income means your assets generate enough usable cash to cover your life without your labor being the main engine anymore. That is all. It can come from dividends, it can come from rent, it can come from royalties, it can come from interest, it can come from selling tiny pieces of a portfolio over time, it can come from a hybrid structure where some income arrives from assets and some arrives from semi-optional work you no longer need in the desperate way you once did. That last model is much more common among sane, successful people than the beach fantasy ever admits. And before we get into the mechanics, I want to draw one sharp line. There are really two major paths people talk about when they say they want passive income. The first is the cash flow model. The second is the total return model. The cash flow model feels emotionally safer. The total return model usually scales better mathematically. And almost everybody who becomes truly stable ends up using some version of both, even if they began by pretending to belong to one camp. Now let us deal with the math behind the sentence, never work again. This is where the internet starts sounding very confident and very clean. You hear the famous 4% rule. It sounds wonderfully neat. Take your annual spending. Multiply by 25, that is your number. Spend $40,000 a year and you need $1 million. Spend $80,000 and you need $2 million. Simple, elegant, portable, and therefore dangerous. Not because the rule is useless, because people turn a probability into a promise. The original idea was never a guarantee. It was a historical rule of thumb built from a long study of diversified stock and bond portfolios over rolling 30-year retirements. Under many historical periods, beginning with a portfolio and withdrawing 4% in year one, then adjusting that dollar amount upward with inflation each year, gave a high probability of not running out of money for at least 30 years. That is helpful. It is not prophecy. Your source lays out that backbone clearly and also notes that more recent work, including from Morningstar, has argued for something closer to 3.3 to 3.7% in some environments rather than assuming 4% is always safe. Faithfulesite Fay turn 95 file 0 Fay. That difference may sound tiny to people who do not respect compounding and withdrawal arithmetic. It is not tiny at all. If you need $40,000 a year to live and the truly safe withdrawal rate in your environment is closer to 3.5% than 4%, then your target is not $1 million. It is closer to 1.15 million. That is a very different mountain. The lifestyle did not change. The math underneath the lifestyle did. This is why I keep telling people that retirement numbers are not emotional numbers. They are engineering numbers. You are trying to build a bridge that can survive weather, not win a beauty contest. The first mistake ordinary people make is building that bridge with no margin of safety because they are too excited by the sentence financial freedom to respect the sentence sequence of returns. I will come back to that monster later. For now, stay with the basic arithmetic. If your portfolio is your paycheck now, then your annual spending is not just spending. It is load on the bridge, and every dollar of annual spending requires capital standing behind it. This is one reason I tell people to stop looking at recurring expenses as monthly annoyances and start seeing them as capital demands. A $15 monthly subscription is not just $15. It is future capital that must exist forever to support it. A $600 car payment is not just $600. It is a claim on the machine you are trying to build. That is how adults should think about consumption once the passive income question becomes serious. Now, the second trap in the total return model is inflation. People hear 4% and imagine a fixed relationship between portfolio size and lifestyle. That is not how the world works. $40,000 today is not $40,000 20 years from now in any meaningful sense that matters to your grocery bill. If inflation runs at 3%, a number that sounds boring enough to be dismissed in normal conversation, the same life that costs $40,000 now may cost more than $70,000 later. That is what time does. It does not only compound your assets, it compounds the price of ordinary life. This is why fixed income can become such a psychological trap for retirees. A person says, "Wonderful, I have a product paying me X every year. I will live on X forever." Number, you will live on a shrinking version of X unless that cash flow itself adjusts upward or is supported by some growth engine in the background. That is why the total return model, for all its emotional discomfort, remains attractive. Equities have historically done something that fixed income struggles to do over long stretches. They have outgrown inflation often enough to protect purchasing power. That is the key phrase, protect purchasing power. Most people think they are chasing dollars. They are not. They are chasing future buying power. Those are not the same thing. Now, let me tell you the adult protocol for using the total return model. Do not plan for the best case. Do not plan for the elegant case. Do not plan for the spreadsheet case, where every year behaves politely. Plan for the boring, mediocre case. Plan for the year when the market is down. Inflation is irritating, and your confidence is not at its most noble. Many sensible people aim for a withdrawal band, not a single sacred number. Maybe you can live on 3% during ugly years and allow yourself 4% or a bit more during favorable years. That kind of flexibility is worth more than many people realize. Flexibility is not only a psychological virtue, it is one of the highest return assets in the entire retirement equation. A person who can reduce spending without panic has bought himself margin. And margin in retirement is what oxygen is in a fire. It stops the crisis from becoming the whole story. Now, let us move to the part most people emotionally prefer. Pure cash flow, dividends, rent checks, royalties, interest. The image is seductive because it appears to solve the main fear at once. You are not selling anything. The principle remains there. The machine throws off cash. You live on the eggs and never kill the goose. That feels safe. The problem is that feeling safe and being structurally safe are not the same. Cash flow assets are usually sold through a dangerous simplification. Revenue is described as income. Revenue is not income. This is where real estate fools people more efficiently than almost any other asset class. A duplex rents for $2,000 a month. Wonderful. That is gross revenue, not passive income. From that $2,000, you must subtract taxes, insurance, repairs, vacancies, capital expenditures, maintenance, and possibly management. Once all that is gone, the money left can look dramatically different from the original sales pitch. The source makes this exact point and notes that a property producing $2,000 in rent may only yield around $600 in true net cash flow once the real frictions are removed. Faithful site Fay Turn 95 File 0 Fay. This is not a small accounting correction. It is the difference between fantasy and engineering. The same distortion appears in dividend investing. A portfolio yielding 4% looks wonderfully clean in the imagination. Then taxes arrive. Then inflation arrives. Then the underlying businesses change. Then somebody discovers that the highest yields were attached to weaker companies or weaker balance sheets than the brochure implied. Then the person who thought he had built a serene machine discovers he has simply bought a job managing his own anxiety. That is why I prefer to treat cash flow assets as stabilizers more than as total solutions. They are very useful. They can cover essentials. They can lower the amount of market selling required in bad years. They can help people sleep. All of that matters. But I distrust any story that implies that 10 rental units or a pile of high Yield securities automatically turns life into a hammock because most cash flow systems require more maintenance, more judgment, and more labor than the public admits. This is where the phrase passive income becomes almost comical. The tax code may call something passive. Your calendar may disagree. A landlord who is coordinating repairs, dealing with vacancies, replacing appliances, handling tenants, and still worrying about taxes and insurance is not doing nothing. He may have built a better life. Good, that is valuable. But better is not the same thing as passive. I have spoken with enough landlords and dividend chasers to know the emotional pattern very well. They reach a number they once called freedom and then discover they have not eliminated work. They have simply traded one kind of work for another. Sometimes that is an excellent trade. A good trade is still not the same as the myth. This is why the hybrid model tends to be the sane one. A core portfolio for long-term growth and flexible withdrawals. Some cash flow for ballast. Maybe rent covers food and utilities. Maybe dividends cover insurance and taxes. Maybe side projects cover luxuries. The point is not ideological purity. The point is resilience. If the market crashes, you want some things still landing. If rents soften, you want some market growth eventually doing the heavy lifting. If both feel awkward for a while, you want enough flexibility that no one bad year forces you into permanent damage. That is the right mindset. Now, I want to show you where the real leverage is, because most people focus on the wrong side of the equation. They obsess over earning 1% extra on capital and ignore the variable that often matters more. Spending. This is not because I enjoy lectures about frugality. I do not admire deprivation theater. I admire power, and every dollar of spending is more powerful than it looks because it is not only a dollar spent today. It is a capital requirement imposed on tomorrow. If you use the simple 25 times rule behind the classic 4% framing, then every $1 of annual spending requires roughly $25 of invested capital standing behind it. That means every recurring expense should be seen through a double lens, the visible cost. And the capital load it creates. This is one of the most useful perspective shifts in all of personal finance. A streaming bill is not just a bill, it is future required capital. A fancy car is not just a car, it is years of additional capital requirement disguised as leather and metal. A luxury lifestyle is not only expensive at the register, it is expensive in retirement math. That is why lifestyle creep is so deadly. It does not simply increase spending, it moves the freedom number away from you at the same time you are trying to chase it. That is like running on a treadmill whose speed keeps rising whenever you begin catching your breath. The source describes this beautifully when it explains that every dollar you do not spend is a double win. It is one more dollar added to the portfolio and one less dollar the portfolio must later support. It also frames this through the passive phi ratio, showing how even partial passive income coverage can dramatically change your sense of freedom before you are anywhere near complete retirement. Faithful site Fay turn 95 file 0 Fay. That is exactly right. People keep imagining freedom as a binary working or not working, dependent or independent. That is too crude. Freedom often arrives in percentages. 10% coverage is psychologically small but mathematically meaningful. 25% begins changing choices. 50% can change your relationship with work completely. At that point, a person may not be retired, but he is no longer in the same bargaining position as the fully dependent wage earner. He can take the lower paying role he actually likes. He can refuse the worst boss. He can reduce hours. He can step off the ledge without falling. That matters enormously. This is why I tell people that enough passive coverage to alter your dependence on bad work can matter more emotionally than a distant all or nothing retirement dream. Now we come to the monster that destroys many beautiful spreadsheets, sequence of returns risk. This is the part most people ignore because it does not flatter the dream. It says something very rude. The order of returns matters, not just the average. You can have a portfolio that produces an acceptable long-term average return and still go broke if the bad years arrive at the wrong time. That is a terrifying truth. And it is also one of the central truths of retirement math. If you retire into a strong bull market, your odds of long-term success improve dramatically. If you retire into a brutal drawdown while you're also taking withdrawals, The exact same average return over 30 years can produce a much uglier outcome. Why? Because of forced selling. This is the silent assassin in the whole system. When your portfolio drops and you still need groceries, you do not get to philosophize about long-run annualized returns. You sell, and the sale occurs at a bad price. Now, the portfolio base is smaller when the recovery later arrives. Fewer dollars are participating in it. That is the permanent damage, not volatility alone. Volatility plus withdrawal. The source lays out this sequence. Risk math very clearly, including the simple $1 million example where a major decline in the first couple of years combined with spending withdrawals burns a huge hole in the capital base that later returns may struggle to repair. It also emphasizes something I think is just as important as the math. People often fail not because the arithmetic was impossible, but because their nerve broke and they sold into fear. Fay Philosite Fay turn 95 file 0 Fay. That second point deserves respect. Math is not enough. Behavior matters. A perfect strategy in the hands of a frightened person becomes an imperfect outcome very quickly. This is why I like cash buffers and short duration reserve structures so much for anyone living off assets. Not because cash is exciting, because cash buys you time, and time during a drawdown is one of the most valuable things on earth. 1 to 3 years of spending in cash or short-term bonds acts like a shock absorber. The market falls. Fine, you spend from the reserve. You do not touch the equity portfolio at awful prices. The reserve does modestly lower long-term returns when nothing bad happens. Good. Insurance always looks slightly stupid until the day it matters. Then it looks brilliant. I have never met a retired couple who regretted having more liquidity during a crisis nearly as often as I have met people who regretted having too little. Liquidity is a form of calm. Calm is a form of intelligence. Intelligence under pressure is one of the rarest assets in the world. That is why the reserve matters. Now let us move away from spreadsheets and into the part that nobody wants to admit until it is already wrecking them. Purpose. There is a dangerous lie hidden inside the passive income dream. It says the final human goal is endless leisure. I do not believe that. A vacation is delightful. Permanent vacation is often a crisis disguised as success. Human beings are not designed only for comfort. They are designed for engagement. They need problems worth solving. They need structure. They need challenge. They need some reason to rise other than fear. When work disappears too abruptly, many people discover that the paycheck was not the only thing their career had been providing. It was providing rhythm, identity, social contact, usefulness, status, friction, direction. Remove all of that in one clean cut, and you do not always produce freedom. Sometimes you produce a vacuum. The source is very strong here. It points out that people often retire from something rather than to something, and that many financially independent people later struggle because they underestimated how much structure and purpose their working life had been quietly supplying. It also distinguishes lean fire from fat fire and argues that for many people the sweet spot is not total idleness but baseline financial independence combined with optional work that keeps the mind engaged. Fay Philosite Fay turn 95 file 0 Fay. That is wise. The most successful people I know in this arena do not stop doing. They stop doing what they hate under compulsion. That is a very different achievement. The point of passive income is not to turn into furniture. It is to buy autonomy, to buy the right to choose, to buy the right to say no, to buy the right to shape your days instead of renting them out under necessity. That is the real goal. Once you understand that, the whole idea becomes healthier. You no longer need the beach fantasy. You need enough structure, enough income, enough reserves, and enough optionality that your life belongs primarily to you. This changes how you design everything. Instead of racing to a giant number and assuming happiness will be waiting for you there, you start building pieces of the desired life early. Maybe you work less before you fully retire. Maybe you drive a simpler lifestyle. Maybe you build hobbies not based entirely on consumption. Maybe you create semi-active income streams you would still enjoy tending when the main paycheck is gone. Maybe you discover that your freedom number is lower than you feared once you stop designing a life around escape and start designing one around fit. This is one of the most liberating realizations in the whole subject. A person who builds a life he does not want to escape from is under much less pressure to fund a fantasy life. He cannot realistically maintain that matters. Now, if I had to tell you what a sane passive income ecosystem looks like, I would describe it like this. You build a base of low, cost-diversified productive assets that grow with the economy over time. You may layer in some cash, flowing assets that provide stability and emotional ballast. You keep a reserve large enough that bad market years do not immediately force bad decisions. You remain flexible enough to scale spending down if needed and income up if the world changes. You keep your skills alive because skill is a form of insurance most people foolishly abandon once the account balance looks respectable. And you define success not as never lifting a finger again, but as never being forced into bad work by money panic again. That is a much better standard. It is more honest, more durable, and far more attainable for ordinary people than the nonsense the internet sells. So, can you live off passive income? Yes, absolutely. But not as a magic trick, as a structure, as an ecosystem, as a mix of math, margin of safety behavior, cash flow, total return, reserve design, and personal purpose. Build it badly and it can trap you. Build it well and it can give you one of the rarest gifts in adult life, autonomy without fragility. That is what I would want for you. Not the beach photo, the stronger life. The one where your assets do enough of the lifting that your choices stop being desperate. The one where market drops are unpleasant instead of catastrophic. The one where a job becomes optional enough that it may finally become enjoyable again. The one where your freedom is not built on a fairy tale, but on a machine sturdy enough to keep functioning even when the world refuses to behave politely. That is what real passive income should mean. Not doing nothing, owning enough of the right things, in the right proportions with the right flexibility. That your life no longer has to answer every problem with the same exhausted sentence, I have to work more. That is the freedom worth building.